think that's
The other thing I would say about it is not to forget that you can, if you need that 15,000, you can add the 10 to 15,000 to the sales price and then ask them to do it, because that changes their payment by a very little amount and it keeps the seller at a full price offer.
absolutely.
And I love that suggestion, Bobby. And that's even something that I've told my buyer is, is even if we're asking for the 15, doesn't mean that they're going to just chop off their price. We may have to go up on their price a little to kind of pad that difference, whether we go up 7 and still ask for 15, so that's it. So just because, I think we are in still a unique scenario where we do have properties setting on market. So that's great for some of our buyers that are needing those incentives. But just like Bobby said, sometimes that's a matter of us still going up in price just to make up some of that difference too.
Well, I think it makes a difference, like you said, if you were doing with one of those hot houses that get multiple offers on the weekend because it's a screaming deal, then you're probably not going to get anything at all. But the best thing you could do is make it so that it's even and they're really not taking any money out of pocket. On the other hand, if it's a POS, ask them to pay the whole thing. Or if it's, that's where we come in with our expertise and say, well, what do you suppose I have to do to get these guys to take this?
Right. With my buyer that we're looking at, we've been looking at everywhere from Green Valley Ranch out to Strasburg, which for us, Strasburg's another almost 40 minutes from town. And he's like, but that Strasburg property is so far away. And I was like, why do you think it's still there? Like, there's a reason it's still there. It's not that attractive to you, and it's not that attractive to a lot of other people, which is why you have a chance to get your concessions you keep asking for.
Yeah, they don't understand that there's a trade-off.
Location,
you don't get the bird's nest on the ground.
Right. And I tell him every time, I'm like, you like this house? And he's like, yeah, I like this one. I was like, so does everybody else. I was like, it won't be here on Monday, I promise.
But he still hasn't even tried.
Well, we're not trying still.
Yeah,
right.
Still hasn't wanted to write it off.
We're getting there. We're getting there.
He's a good agent.
I think that's probably the hardest thing about a changing market is that not only do we have to change our thinking as agents, but buyers and sellers both have to change their thinking too. And it usually takes about 6 to 8 months of getting beat up before you finally
Make a shift.
What market we're in.
Well, and ironically, you mentioning an 8-month mark really literally is where we're at today. June of last year, it shifted. 8 months later puts us into February. I think now some of our
people are starting to catch on.
Exactly. So I think people are starting to catch on. Our sellers' expectations have kind of been, in my eyes, they've softened. I think seller expectations have softened, and I think
they understand where they are.
Buyers are, a little bit more accepting of where rates are. I mean, I think they're still floating in the high 5s to 6s.
I think
so. So I was going to share my screen real quick because I pulled stats from Denver. Obviously, anybody has access to their MLS and usually has access to pulling stats similar to what I've pulled. Let's see, where am I? So I'm a big fan of using RPR. This is RE Colorado out of Denver. RPR is usually attached to your association, your realtors association. If you're a realtor, you usually have free access to this. If you are not a realtor, you can gain access, I believe, but you think you have to pay. But RPR is one of my favorite stats to pull from. But I pulled a couple reports just so we could look at them. And I did just the Denver market, just so we could use it as an example. And I had a listing go active here recently, and I used these stats to help my listing. My listing was a little overpriced last season in September, and I thought it then. And so we're in a position now where they're going to put in another offer. They want to sell their house, but they want a very particular house. So I at least fueled it with stats to pick the appropriate price. So we dropped it actually from 1,369 and I got them to go down to 125. So they dropped 120 grand. And here's what I did to help kind of shape that. I used Arvada stats more specifically, but this is Denver. Estimated home values in Denver down 0.84% over the last month, and down 3.4, almost 3.5% over the last 3 months. But if we look, estimated home values over the last 12 months is still up 10%. Right. So we have seen kind of a bit of a downturn and a little bit of a change over the last quarter, but really over, estimated home values over the last year is still up 10%. If we keep looking through here, here's estimated values up 10, up 30% over 24 months. Here's basically the foreclosure distressed properties. There's 134 that just entered into pre-foreclosure. There's 2 in foreclosure. That's a pretty small number. 2 actually in foreclosure for all of Denver. Here's sales price. Actual sales price over the last 12 months is what? Sales price over the last 12 months is only up 2%. So we've estimated up 10, but we have actual sales price only up 2. Pretty flat market is really what's transpiring. Over the last 3 months, the actual sales price is down 8.5%. And that's some of the stats that I use for my sellers is look at what's happened over the last month to last 3 months. Prices are actually going down at almost 9%. And it was the same way for their neighborhood. It was about down 10% for them as well. Here's list price. And this is what I used also to help me get their list price down, is over the last 12 months, list prices have gone down 7%. So even if you wanted to list last year, it's telling you last year, same date, you're listing almost 7% less than that over the last 12 months.
They've gone down 3.33% since December.
Since December.
It's just December.
So why do I use these stats? I use these stats to help soften my sellers' expectations. But why is that important, and why do I do that specifically? Me personally.
Well, you're setting the expectation, right?
Right here, I'm setting it because of this expectation. Price decreases. There was 747 price decreases in 7 days. There was 743 new properties in 7 days. So just as many properties that came new is just as many properties that price reduced. So the reason I use these stats is so that way I can help reduce that price on my listing side. If I list it down and appropriately where it needs to be, I end up being the house that ends up being pending in the last 7 days. In the last 7 days, we've had almost 1,400 pending. Twice as many pending in the last 7 days as actually came on the market. So it's heavy activity. There's higher buyer interest, but not everybody gets picked. Okay. The other stat that I use to accompany this same theory and approach is I pull up stats from, this is a particular neighborhood report. This is market activity. So neighborhood report, I use, it's not in here. I gotta pull the other one.
I think the other thing that to keep in mind is that when you allow your seller to be overpriced so that they have to come down, the message is they're starting to get desperate. Now the buyer, instead of taking them at their lower number, they want even more because they've assumed that now you're desperate.
Now you're desperate. Now you have to sell.
Cost the guy money that he could have had before, and now he's probably going to end up with less than if he just listed it right in the first place.
And I like that you brought that up. So this is why I shared that I think that's exactly what I'm saying, Bobby, is if we look at this slide here, it's my list price versus sales price report. Listings that sold in less than 30 days sold for how much over list price? Those that listed.
What is that number?
2.4%.
Okay.
So two
And if
point
you
four
have to
percent.
reduce it, you reduce it even farther.
So everybody who was on the market for 31 and above days either went flat or almost 2% under their list price. So it's more important for us to price appropriately and get an attractive list price and hope that we go up the 3% as opposed to pick a bad price and know that we're going to come down. So I use these stats usually to help frame my seller's expectations. This is not the same stuff that I share with my buyers, though. I don't tell my buyers, hey, we're down 7%, because then they want to start going down 7%. But that doesn't mean the house that we're after is in that same arena. I thought this was,
Sometimes I think you have to remember that the objective is to get them a house, that for sellers, it's to get it sold, and for buyers, it's to get one purchased. So you share only what's necessary to accomplish that.
I love that, Bobby. And that's exactly, I think that that's what we have to do is we have to put on the hat. Am I a buyer's agent or am I a seller's agent? I'm certainly not sharing the same stats and statistics with my buyers because it drives them the wrong direction. And I certainly not fueling my sellers with all of the market activity for some of the rare houses that are seeing the activity. Like they're just different scenarios.
And then when that happens is when they don't get a house, who do they blame? They don't
Me.
blame themselves. They blame you because you told them that houses were going down and that they'd get a better deal. They believed you and they haven't gotten one. So now who are they mad at?
I'm mad at me too for telling that stupid
Exactly.
story.
Exactly. You
Right.
need to be told.
What's that? What do you got, Haley?
Go back to the MLS and adjust that to 24 hours.
So
77 listings. We've had 118 price decreases and over the weekend and within the last 24 hours, obviously, you know, what did we say? Let's wait to see what's gone under contract. 308.
Well, so remember, so we have seasonality to everything, and that even includes the week. So Monday, Tuesdays we see high pendings. Wednesdays, Thursdays we see a lot of new listings, and I would say Monday, Tuesday, Wednesday we see a lot of price reductions. So even in the week, we're going to see a lot of changes just in those stats. Here's another stat that I shared last year that I think is kind of I say promising or maybe telling to the market that we can anticipate, and it is right here. So here's neighborhood stats for the Denver neighborhoods. Here's percent change in permits for all buildings. So this is percent change of permits for building permits. What's the percent change? Let me zoom in real quick. What's the percent change for building permits for Denver County?
Negative 48%.
It's down half. It's down 50%. So building permits are down 50%. What would that allude to?
Well, builders aren't building. That means that they're not seeing the market strong enough to support their financial risk.
What happened to us in the 08, 09, 2010, 2011? Very same thing. Building permits were reduced half to 3/4 of the amount year over year, which then by the time we got to 15, 16, 17, we had years of building had gotten behind. I think this alludes to continued inventory deficiency.
Well, I think that's a great one to share with buyers, because all that means is that as soon as the market calms down and people get used to these numbers, that it's probably going to be supply and demand yet again. And we still have all these people who didn't get a house in the last few years, more people coming, and now 50% fewer houses. What do you think happens to the price?
There you go. So this is my
step. Share it with the seller, though.
I wouldn't share it with the seller. I would share it with the buyer. So that's where stats and data really help fuel the conversation for whatever party we're supporting. Why do I want to buy a house right now? Interest rates are high and it seems like it's a bubble, it's bursting. It's not bursting. They're building half the number of permits are being even pulled. There is no bubble. We're gonna have an inventory deficiency. Bless you.
I think builders don't want to build either because now they have to pay realtors to sell their stuff.
Yeah, that's
Yeah, they always had to.
Yeah.
So,
You know, it was 1% in 2020.
well, that yeah, but material cost is so expensive, and I think market volatility is the sensitivity. So they're just not sure. Is it worth the risk right now to potentially not sell them? And that's where I think we're seeing it. It's just not worth the risk.
well, if they were around in the 2007, 2008, they're probably terrified because they got either went bankrupt or nearly went bankrupt through that one and said, I'm not doing that one again.
And I think a lot of them rode the bubble over the last couple of years, held tight where they're at, and they're reducing their effort, reducing their exposure and liability.
Mhm.
Yep. So I think a lot of builders are in preservation mode is what they're doing. They rode high, saw huge increases, saw a lot of production, and then now they're just sitting tight because they don't want to experience the 8, 9, 10, 11.
I think one of the things though that I love all your stats, however, and I would say this for new people, I think experienced people have about probably the right amount of knowledge of how much stat to give to people, but stats are usually boring people to death. And I think if you overstat them, you will probably end up with no buyer or no listing.
I like it. I like that, Bobby. Tell us more though. What's that feathering point? What's the happy medium?
I think you pick whichever side you're on, but about 2 with no more than 3 of these demonstrations. And if that doesn't make your point, I don't think your guy is sold in the first place. If we're talking about, so in a listing, you need to already be his new best friend and they love you. And now we're finally down to the part about price. So let's get it priced right because I don't want to let you down later. So let's make sure that we get this price right. Let me show you this, this, and this. Show them 3 stats and then say, so what do you think we ought to do? And come up with a price. If all I'm saying is if you overstat, and the only reason I'm bringing that up is I think a lot of times when people are newer in real estate, they want to avoid ever getting to the part about closing because that's the scary part. So they will do just about anything to milk this as long as possible till they think maybe if the people fall over dead, they'll just sign the listing on the way to the floor and never have to close, right? So don't overstat it. I would say take 2 to 3, point it out, and ask them what you think we ought to do.
I like that. I like that. And Bobby has a great and unique way of leading, guiding, and supporting her clients into making the right decision, Bobby.
Yes, which would be
Yes.
my decision.
It just happens to be
And
theirs.
as you said earlier, that would of course be the right decision.
Right. And Brian knows this all too well.
I have explained it more than once.
Right. So I think, on today, what I wanted to share was really, kind of what the angles that I take and I look at things. I like Bobby's point with not oversaturating stats, but let's be honest, confidence also resonates with stats as well. If I'm not sure about the stats or statistics I'm sharing, it's probably usually translated through my communication. So, I mean, if you're not confident or comfortable with the stats you're sharing, maybe you shouldn't be sharing the stats. What do you got?
Absolutely. 100%. If you don't know what you're saying, stop saying it.
Don't say it. Right. Haley, what do you have a thought?
Sorry, everybody's really small on my screen right now, so I'm like, first and foremost, everybody has a different listing presentation. They have a different buyer consultation. Every agent presents information differently. I had 2 listing appointments this weekend, and what I can say works for me might not work for anybody else. But what I do is I before I go to my listing appointment, I look at the area, I do all of my research, and then I choose usually in my initial conversation, you know, they're throwing numbers at me already, right? So if my listing appointment on Saturday was 550, 600,000, my home bought this, Zillow that. Cool, you know what? That's great. How about when I come and look at the property on Saturday, we'll sit down and we'll actually look at the MLS together in real time so you can see what is actually going on in your area in real time. So rather than me just feed you a bunch of information, you can actually see it with your own eyes and make an informed decision. Oh, I really like that. So when I get there, I do my normal thing, which I already have my presentation created. I use something called High Note, which allows me to just attach a ton of different reports, whatever I want, into one area. And I also include a YouTube video from a real estate coach who's talking about Zestimates and how accurate they really are. I personally really enjoy it, as well as some information on HomeBot. And what I found in using this High Note presentation is I can look at the analytics to see what they're opening up. And every single time, the only thing they're opening up is the seller net sheet, which I personally include. So I sit in front of them after I've walked the property. I'm talking to them, asking them really about their motivation, their timeline, that sort of thing. Then we start looking at the MLS, and I point out, hey, see this house that's priced at 550 right down the street? What do you think of this? And they're looking at the photos and they get real quiet. And I can tell that they're realizing that they might have a problem. I don't have to tell them, hey, I think you might have a problem. I flat out just say, so what do you think about this house in comparison to yours with the condition it's in? Now they're telling me, you know, they're bringing it down themselves rather than me being the naysayer, which
I think you're perfect, Haley, as you always are. You're wonderful. Because remember, that's what we talked about in Power Series, leading, not pushing. And you're letting them make it. They think they're in charge with you doing it that way. It's wonderful.
And they also, that house was having an open house, and I told them, the husband was like, oh, we don't need to see that. Like, I understand what you're saying. And I said, hey, that's great. I recommend going to look at it because you never know. This could be good or bad for you.
Right.
The wife went and she's like, I feel so much better now. And thank you so much. I mean, she just you could tell in everything she was saying, she felt fully informed and trusted my guidance, which was great. And then on Sunday, I took a page from Bobby's book. I've never met these people before. I go into the listing presentation. I had all of my paperwork ready to go. Pull out my nifty little iPad, do the same thing, same exact thing, and I got it signed right there. So for me, I include these reports. I think they're valuable for people that are really data driven, but not a lot of people are really that way. At least not a lot of people that I talk to. They want to know what their bottom line is, period. How long do you think it's going to sell? Well, here, let's look at these stats right here in person. This is what I think. And if this data is correct, this is where how we'll know we're having a problem. You know, based off these showing statistics in this area, this is how many showings they reported last month they got on, you know, last month in this price range, sort of a thing. And they kind of adjust their own price and move forward.
I think, you know, one thing that you help them realize though is, you know, I think everybody has a skewed or jaded version of their property. Oh, mine is the best. Mine looks the best. I did the floors.
Yeah.
You know what I mean? I put in these nice, shitty countertops, you know? I think with that, by you inviting them to those open houses, you know, hey, go look at what 550 is priced right now. And if you're not there, we'll also monitor it. Them being at 550 and having the open house and seeing it, and then maybe that 550 doesn't go under contract. Well, then that also helps us realize that 550 might even still be too high.
I highly recommend personally, you know, knowing what you're dealing with before you get in there. So you're not trying to analyze the data with them right there. Like, oh, well, let's see. Know what you're working with before you get there. Know what is active in your area. And if you already have an idea that they're overpriced or during that time they want to overprice it, offer to take them to the unit next door, whatever's in the area. Let's go look at this one, because if we go live this weekend, this is going to be our competition. We should check it out.
Right.
And I did that with my most recent listing that closed. They wanted a price 10,000 over the active that had been sitting there for 2 months. We went and walked to that one and they priced it 10,000 under, and we got it sold.
There you go.
So letting people see for themselves what they're actually working with usually puts them in check and makes them realize that they're being a little unrealistic.
It's like dating. You got to go take them out to go see what the other dating pool members look like. And they're like, oh shit, I'm not there. I better drop my expectations a bit.
This
Yeah.
worked for my buyer this weekend too. I mean, same thing. She thought that the house that we should offer a lot lower, but then I show her, the piece of shit house down the street that I really think should have a bulldozer is only $35,000 less, which, kind of made them wake up like, oh, maybe they're not overpriced.
Right.
So it kind of goes either way then.
Right.
And I also do that for buyers too. When I'm in a property that they love, but this is me, obviously. I have my iPad. My iPad for me has been a game changer in my business. Just for me, I'll be doing a showing if they love it. Let's look at comps right now. Let's look at what's going on right now. Because I kind of already have an idea, usually what's going on. That almost always puts it in perspective for the buyer. Like, okay, yeah, this
I
one.
like your iPad idea because I'm showing them on my little iPhone. I'm showing my 80-year-old client on my iPhone the house instead of having the bigger screen, which totally makes sense.
So here's my own unique buyer approach is if somebody wants a property, I ask them, do you want the property? Yes. Perfect. Let me find out what it's going to take to get the property. And then I call them back after I have all the information and I say, hey, just check it in. Do you still want the property? Yes. Perfect. Here's what you have to do. Oh, I won't do that. But then you don't want the property. Let's just move on. Let's skip it. We're not in a position to get this property. Oh, I want it though. Okay, so are you willing to do this? Okay, let's do it. Or no, let's move on. I'm definitely not one that like I use do you want it? And I'll give you an example. I have clients right now that I've been helping since 2015, and this is the fifth time I think I've listed their house to buy another house. And this was the time where I said we overpriced it last September, missed the chance. And this was the time where I said, guys, do you want this house? Yes, we do. Well, great. Now we got to list your house at 1.25. And because they want it, and because I have 8 years of relationship with them at this point, they actually do take my guidance. They do listen to the statistics. They do listen when I share the specifics. But I think Bobby's right. Sometimes sharing too much is too much. And if we don't have the relationship and we don't have that trust built yet, the stats don't mean anything anyway. They think it's us fueling our self-interest and not fueling stats and statistics.
I think that the problem with having too much is that when you have too much, confused people make no decision,
Okay.
right? Because if it's just overwhelming, what do? Think about it. You just throw up your hands and say, I'll do it later.
Oh, this is too much.
And then you don't do anything. So
Very
that's why I'm
good.
saying overstat is just like, what did he say? What was page 3? We're on page 27 now. I don't remember. There was something he said and and I can't understand it all. I can't grasp it all. This is your world, your words, and you understand this. And I'm just the public. I don't know what you're talking about.
Never. This is too complicated for me.
I'll just stay out. I'll wait till things are better.
Well, I mean, if you just look at the 3 reports I pulled, there's 60 pages worth of content in the seller report, another 12 pages in the neighborhood report, and another 21 pages in the market report. So it's
Can you
almost
imagine having to sit through all that?
100 pages worth of stats and statistics.
Of course, I might buy something from you just to get rid of you.
Done, Bobby. I heard that. Everybody else did too. It's recorded.
Oh. Yeah.
With Haley's point on those estimates, we found out, so when I listed my sister and brother-in-law's house, Zestimate said it was like in the 600s until we listed it. And then Zillow comes back and says that it's 915. So it just changed overnight by $300,000.
Well, here's the thing. Zillow doesn't know the condition of the actual property. I mean, literally, the house across the street can be a completely dilapidated meth house, and Zillow doesn't know that.
Mm-hmm.
That's exactly what I tell my clients. If the house across the street from you was burned down, Zillow doesn't know that in their estimate.
It's so funny you say that because the same week we got theirs under contract at 890, the house across the street listed for 775. Which I'm like, damn, I'm glad we got under contract.
And then
Yep.
your people terminated and bought the neighbor house.
Oh no, we're closing on Thursday. We're
There you go.
done.
Congratulations.
Thank you.
Yeah, so this is good stuff. I think we just need to be mindful of what the spring has to offer. I think it's going to be very much a high activity spring. I think we're gonna have a whole lot more sellers entering the market who think that they maybe missed it last year and think that we are. I call it fear-based selling. I think that we're gonna have a lot of fear sellers. But I think we're also gonna see a strong market of buyers. So I think we're gonna have
I agree.
a good, strong season.
Can I point out some statistics that I know of? So does anybody here actually look at the market trends report, like look through the actual report that is provided through DMARC, if you're a part of DMARC?
More.
No.
Okay, well, so this is what DMARC is reporting. Mortgage applications increased by 29% within just the last 2 weeks. So buyers are coming out, definitely, we already know that. Our pendings increased by 51% from last month. Rates came down to an average of 6.125. New listings are up, they say 65% month over month, however, actives are still actually down by 13% of what they used to be. The end of January, we ended with 4,120 active listings versus the average from 1985 to 2022 of 12,429. So what they're saying is that our inventory obviously is still very low, and that with this new buyer activity, they're just starting to eat it up, which obviously we're seeing with all these pendings, that we can see that clearly, right?
Right.
What's interesting is 37% of owned property is paid off. And 86% of homes with a loan are locked in under 5%. So what they're saying is they anticipate that sellers are not going to be listing unless they have to because of the interest rate that they're in.
They can't replace it.
Right. And I'm one of those people. I want to move. Anybody that's worked with me, even for one day, has heard me say, I want to move because I desperately want to move out of my house, but my wife won't let me. But when I start looking at property and I'm actively still looking, Nat helps me with that. Thanks, Natalie. I kind of get in the moment where I'm like, what I have versus what I'm getting for the rate and all of that. And I kind of juggle with that. So I'm just a regular person. So that's in real estate. So I guess I can say that I'm feeling what I'm hearing sellers talk when they talk to me, which is part of really getting down to their motivation when they're wanting to sell. Home prices adjusted down 3.33% just from last month, like we talked about earlier. And the close to list percentage has dropped to 98.15%, whereas it was well over 100 and something percent on a regular basis. In other words, people were paying more than list price on a regular basis. Now, 98% of the time they're paying under list price.
Well, they're on average paying 98% of this price, right?
Or 98% of that. Yeah, 98% of that price. So, but still, which is under list.
Which is what we're saying here. I mean, under 2%, close the list price.
So I think, me personally reading those reports, and I try to look at stuff weekly. So when I'm talking to, clients for their weekly update, or I'm talking to prospects, I can back it up. I'm not just kind of winging it. I highly recommend looking at those reports. They even give you just kind of like quick stats that you can just spit out like I just did.
Well, and I think even being able to speak to specific stats and market trends, even while being on any appointment, whether buyer, seller, consultation, it still speaks to experience and confidence. If you're just speaking to the market, it shows relevance and participation. So, you know, knowing is half the battle, I think is what they say.
I'm about to call somebody that I met with last week, to let them know, hey, mortgage applications jumped by 29%. That's great news. You know, just a little update. to
Right.
Go along.
Right. Good stuff. I like it. Anybody have any wishes, comments, hopes, any thoughts on kind of the market? Jesse is on the call with us today. He's with Geneva. He's jumped on a couple times with us. He's going to kind of share some of where I think he believes things are going to go, but also kind of what programs are available, as well as kind of where programs are going for lending and our buyers. Let's everybody say howdy to Jesse.
Hey guys,
Hi, Jesse.
Hey,
Jesse.
how's everybody today?
Well,
It's not snowing. See?
yeah, the sun's out.
All right, let me get
I'm
in
gonna
here this thing real fast.
yeah, I'll give you access to. There you go.
All right, can you guys see my screen?
No.
No.
And I'm older than I look, guys, so technology is a thing. All right, there we go.
You're in your late 40s?
Feels like it today. Feels like it. Early 40s. All right. Now, can you see it?
Now we got it.
Yep.
All right, cool. All right. Good morning, everybody. Let's go over a couple things today. Haley was just talking about interest rates. We were at about a 4-week low, 5-week low until yesterday and the day before, and it did jump up about 20 basis points. So that's probably affecting people's actual interest rate anywhere from an 1/8 to a 1/4 of a point. One of the big reasons that did come up is the jobs report, was a little bit different than what we were looking for. We're still trying to curb that inflation. So it's like it's almost like we want, unemployment to go up, versus going down. It's just a wonky thing, right? So, but the CPI report last week, or 2 weeks ago, that came in pretty favorable. So there's some things going in our favor, and we were down into the 5.99s for a pinch of time. And then in the last week, it's kind of crept up. So the last time we met, I was looking at it, and we were at like 5.99, and that was about 3 months ago. So it's kind of ebb and the flow of where we're at. So, and when we are looking at interest rates, you always want to, this is a base rate, right? So this is when you are looking at, if somebody has 740 credit with 20% down, so when we're seeing these rates and you have people kind of looking at it, it's really going to come down to, they can get whatever rate they want. It just depends on what the cost is and how people spin it, right? So you can, people are going to, either add points onto it or their actual par pricing with no cost. So, if you have people shopping, which I totally recommend shopping because it's, it is going to be helpful. Darla and I were working with some clients, and, they ended up getting a rate that was, much better than I can offer, and they jumped, and that's totally understandable, right? So
Sorry, Jesse.
no, it's not. If you're getting a girl, that's all that matters, right? So we're a team. So
Yeah.
you can't win them all. But like what we did with her, we were able to transfer that appraisal. So we didn't cancel the appraisal. So, we're a team over here, right? So but it really comes down to doing an apples to apples comparison, right? So if you have somebody that's getting a quote and you're like, oh, that seems high, there's probably a reason. And we're going to jump into that here and later in the presentation about loan level pricing adjustments that is coming in hot. So, at a glance, this is still much better where we're at. A lot of people I follow, economists and mortgage people, they're saying the teetering point for affordability is like 5.75 and 5 5 8/8. So right when it clicks over that is really when people are feeling that pinch. So, people are estimating we will be in the, mid fives, hopefully low fives by the end of next year. We can all pray for that. But we're not in the sevens. And that's what I'm telling a lot of my clients now, right? So when it climbed up so fast, people are like, oh my God, it's so high. It's so high. Where's the 3 and 2% interest rates, which who knows if we're ever going to get back there. But we're not in the sevens, baby. That's all that matters, right? So, but doing, like Bobby was saying, increasing the purchase price to then get those credits, every $1,000 you add onto your loan amount only increases your payment by $6 to $7. So 15, 16K is not even affecting your payment $100. And do you love that house that much, to where you can get into it and maybe not go out to dinner one time, right? Say not go out to Red Robin once and, have a subpar burger, just stay home and cook your own burger and it's going to be better anyways, right? So, so that is not a bad option. I have seen 2 appraisals come in short because of that recently, because they are using more recent data. So if somebody has to sell, like Kaylee was saying earlier, you have your have tos and your want tos, and the have tos right now are giving up the farm. So sometimes that is affecting the, some comps in the area. So be careful with that. I wouldn't be writing any appraisal gaps if I'm doing that, but at the same time, they might have to, come to a little bit of terms with splitting that the seller credit. Applications, applications were up as of this week over week. Over last year, they're down 10%. You can see at the very bottom, they are down 66% for refinances, which is not unexpected. It's also the have tos, which I have some people reaching out now and saying, hey, I know I'm at 3 or 4%, but I really want to pay off this debt. And when it comes down to it, if they're paying off high interest credit card debt, student loans, that kind of thing they already took out of the federal loan, it still might make sense for them money in, money out, right? Because you're still getting an interest write-off and you just want to actually get a full picture of it to see if it actually makes sense, right? Because if you're just paying a HELOC, that's 10% and it's $100,000 and now your HELOC's at 12%, you're paying $1,200 for that HELOC. And is that worth it? To save your interest rate where, your payment might go up $400, right? So, and that's where people are tapping into some equity here pretty soon. There's going to be something that I was looking for a slide I couldn't find, but talking about refinances, has everybody heard about the 12-month rule that's coming into effect? So here pretty soon, if you buy a home, if you don't have ownership for 12 months, Fannie and Freddie, Fannie is saying that you cannot refinance that unless you've owned it for 12 months now. I'm sure the other one's going to follow suit, but that is affecting people that are doing flips and buying investments and saying, hey, I'm going to buy this house and then cash out and get my money back at it. You're looking at maybe having to wait 12 months for that. So make sure some of your investors know that, and I'll get some stats on that and, shoot that over to the team. So this is a 12-month average for the interest rates or the applications on this front. So DPA program. So we have an excess DPA program that's pretty cool that we just kind of launched. We've been kind of trying to work some details with them.
DPA means what?
Down payment assistance.
There you go.
Give me the monies, all the monies, right? So this one's cool because they go down to 600. Every other DPA program out there is a minimum of 620 to 660, depending on debt to income and all that. So like CHFA is 620, and you can't go over 50, back end of your debt to income or your DTI if you're under 660. So this one, you can go up to 55 if you need to, minimum of 660. But also the big thing is that you get to use 160% of the AMI, which is the average median income. Right. So that's huge for some people that, you have young kids that might be making a bunch of money, but they're not saving anything. And, CHFA kind of, throws them to the curb because they're making too much money. Right. So 160%, that's a big jump in income. You do not have to be a first time home buyer, free education. This one's cool as well because most DPA down payment assistance programs do not allow non-OC co-borrower. So that's a parent, a brother, a sister that could potentially help you co-sign to get into a home. They do allow this, right? So, for allowable fees, that's more like if they want to buy the rate down or whatnot. So that's kind of what that looks like. It is a full 3.5%, down payment, which it covers. And then they have two options. So you have a forgivable one after 10 years. Then you have one that is amortized over 10 years, right? So the first one, the payments are, they are deferred. And then the second one, they are not deferred and they add in payments. So of course, the first one's going to be a higher interest rate because you're giving them, they're getting their money back. And the second one is going to be a little bit lower.
So down payment assistance program, first program, you get the down payment assistance at basically no payment increase, but with a higher rate that falls off after 10 years.
Correct. Yep.
Or the second down payment assistance program would be an interest rate of plus 2%.
Yeah. So say it's at 6, then the other one's going to be at 8, and then it's going to be a 10-year term. So that one's going to have a better interest rate overall. The one that's forgiven is going to be a higher interest rate, but it is going to be, it's going to be pretty comparable to Chaffa or like Metro DPA, which Metro DPA lately hasn't even been really offering a lot of down payment assistance because they're kind of just waiting for the market to cool before they start giving away free money.
There you go. So it pays to save money.
Yeah, exactly. So here is kind of what I was talking about earlier with the loan level pricing adjustments that are coming. In the red is things that are, changing. And then there's other things that are, the green are going down. So it's kind of unfortunate the Mortgage Broker Association is fighting this with the secondary market. So Fannie and Freddie are the ones that are doing this. They are going to start hitting people's pricing. For example, a 740 borrower that's putting between 20 and 15% down, they're getting hit the most, which is kind of ridiculous. And that's what we're really fighting. Like, hey, this is, grade A paper that if they are 740, they're putting some, down payment in, they're the ones that are getting hit the most. Your lower down payment bar or your lower FICO and down payment aren't getting affected as much, right? So it is, it's helpful for people putting less money down, but it's not helpful for people that are putting money down, 720 plus, which is kind of silly. There's also another factor into this that they haven't really spoken about yet, but debt to income will play a bigger factor in the down or the interest rate as well. So say you have somebody that is teetering on their debt to income is teetering at like 43 to 44, and then all of a sudden their the interest rates go up 1/8 of a point, and now their debt to income is over 45. Well, not only did their debt to income go up and their rate might have gone up, now their loan level pricing adjustment might have even gotten worse. So there's that teetering thing. So I always I try to give a little bit of buffer so my borrowers don't have any surprises. So it's like not maxing out their pre-approval to the dollar, because then that way they have a little bit of a buffer if rates do chance go up or something like that. But yeah, I mean, it's going to be a tricky thing here, and people are going to be shocked when they see some of these things coming down the pipe.
So miss a credit card payment 1 month.
Drop your credit score by 50 points. Right.
Yeah, and that's where it comes down to like looking at saying, hey, let's look at putting less down, because it's and that's the risk factor, right? Now they have mortgage insurance, higher mortgage insurance coverage versus them putting more money down. So it's just a safeguard for the investors.
Glenn, did you have a question? Yeah,
I did. Thank you, Jared. Jesse, on the Essex program, the down payment assistance,
Yes, sir.
how much is what's the max amount that's contributed? 6%, 4%?
3.5.
3.5. So they're
closing
covering they're covering the full down payment. So this one is a 3.5% second. So either FHA or conventional, but they're giving at least 3.5%. So it's a flat 3.5.
Okay, got it. versus there's two other programs out there that are 4% and 6%.
Exactly.
Okay,
Yeah, and it's kind of give and a take, right? It's kind of like the whole like, you get what you pay for type deal. So you might be, if they're giving more money, they're going to ask for more money, and that interest rate might be a little bit higher as well. So, this is going to be kind of for somebody that makes a little bit more money, and might have a little bit of a a FICO score.
gotcha. Thank you.
You got it. Any questions on the LLPAs? And this is kind of taken effect on cash outs in second homes already and investment properties. So I'm sure if you guys have, looked at pricing for second homes or investments, you realize that it's about, 400 basis points more expensive than a primary home. And what that really means is, sometimes you might have to buy a rate even to get on the board, or your rate is going to be at least, 2 to 3 points higher, depending where it is. For those second homes and those investment properties. So this kind of just talks about, the agencies and, what they're kind of looking at, basing off the, credit scores and stuff like that. So it is going to kind of factor. I'm going to be giving more cushion when it comes to debt to income. We just had a whole company-wide conference call about this, about not trying to, fudge the numbers per se to get them under 44. So their interest rate doesn't change, kind of thing. Cause if, there's an audit on the backside, that's considered mortgage fraud. And I'm not looking to get myself in trouble over, saving somebody 1/4%. Sorry.
Seems fair. Seems fair. Yeah.
Seems fair. We had, and there are, there's more programs coming out, and I'll get some more information on these as well. But, like the DSCR programs, bank statement, programs are coming back with only 12 months of bank statement averages. They're allowing, business bank statements now. So the non-conforming, investors are coming back into the market a little, stronger, because they feel like they are, it is trending in the right direction. Jared and I did speak about a 40-year mortgage for one of our clients this weekend. And it does help you for your debt to income, but then your interest rate is going to be drastically higher because it is a non-conforming loan. So it's essentially just like a jumbo with somebody putting less money down. It does help, the scenario we had this weekend was 10% down, 400K, and the interest rate was between it was like around 10%, right? It did save them still save them $200, but then they're paying a way higher interest rate. So that's another have to versus want to, right? How many of y'all got on that marketing class last week? Was that last week before? Yeah, January 31st, almost, last week-ish. So
Yeah, it was last week. I thought.
Yeah, say again.
I thought it was last week. I don't think it was on the 31st. Oh yeah, maybe it was last week.
I have no idea what it is. I have 3 small kids. It's the only time I know what day it is when my kids wake up and say, "Hey, Dad, is it the freaking weekend?" I'm like, "No, it's not. Go get dressed for school." So every day, it's awesome. "Hey, Dad, is it the freaking weekend?" "No, baby, it's not." But yeah, I just want to kind of get your guys' feedback. I know some of you guys were texting me while this class was going on, a couple of things. So our marketing department is really, really good. They're really top notch. They're trying to, get things to where it makes your life easier as well. So if you guys have any questions, they are going to, I think they did record this one, so I can send it out to you guys to see where it is. But James, he was just recognized as one of the top marketers for the mortgage industry in 2022. So he's doing some really good things.
Voted by his mom.
His mom works for Housing Wire, so he got an in. He got an in, right?
That's my boy.
Yeah, that's my boy. But no, so yes, but he has some cool things like that. Digital planner is really cool. Goal worksheets and stuff like that, where you can kind of plug and play. And I think I sent that to you, Brittany, a while back, as far as like, how much money you want to make, how many deals you need, how many leads do you need, just to kind of put, pen on paper to kind of see where, how many deals you need to do to live your life, right? So yeah, so if you guys have any questions on that class, as soon as it does, they release the recording, because I think they're gonna shoot that out here in a little bit, and we're always gonna have things like this just to kind of help give you guys a different perspective of, you know, what else is going on in the market and what other people are doing to, you know, gain some business.
It was good stuff. We appreciate it. Any,
Be a good human. That's it.
any questions, I guess, about lending, kind of where rates are at, where we're going? Any questions for Jesse?
I would say rates. I think one of the things with the cash out thing, I feel like the market feels like rates are going to get better. And I feel like that's one of the reasons why they are doing, you know, holding off on that 12-month refinancing, because a lot of these lenders make money off of servicing, right? So you either have a lender that's making money off servicing, or they're making off selling that loan, right? So depending where they're at, they don't want to then sell this loan and then it gets refied in 6 months, and all of a sudden they just lost, you know, the agreement they have with their servicer is that they're going to hold that for 12 months. So I do feel like this is a sign that they believe that rates are going to come down as well. They also are, you know, they are worried about values as well. So that's another reason why they did the 12-month thing, just to kind of let it level out a little bit. You know, if you have somebody that takes out every, you know, cent of equity they have up to that threshold of, 80%, and then all of a sudden their values go down, you know, then if they sell it, they're still gonna have equity, but, you know, that's one of the reasons why they did that 12-month rule as well.
There you go. Now you know. Now you know why. Good stuff. Anybody have any questions, comments, wishes, hopes? No? Well, thank you very much. Thanks everybody for jumping on. If you guys need anything, reach out to us. Jesse, thanks for the update. Make me host before you leave, so I end up with this recording.
No.
No, well, then you're gonna just have to send me the recording.
How do I do that?
Thank you all. If you guys need anything, reach out and we will
Thank
chat
you.
later on. Thanks.
Have a successful week, everybody.
Thank
Thank
you.
you. See ya.
Hey, Jared, how do I make you the host?
Go to the top right corner of my window. Where you're seeing all the little windows.
My chat box is in the way. Let me see if I can get rid of that.
Yeah, if you look at the little windows up in the where you
The
can
three
mute
dots.
the 3 dots.
Oh, there it is. A little window.
Yeah.
To the window, to the wall. Make host. Oh, now your window's gone.
Should still be there up at the top.
No, it's not. Just me and you now.
Yeah, but that's fine. Just go up to my little window. Well, I guess, yeah. So, I mean,
Yeah, you don't have a little window anymore.
so then at
I
the
was literally
bottom,
getting ready to click on it, and then it.
Is that there?
so yeah, you could go to participants list on the side, the little 3 dots.
All right, participants.
Reclaim.
her.
There you go. I just reclaimed it. I took
You
it
didn't
from
even
me.
need you.
I didn't even use it.
I was like, I'm gonna mess it up.
Did Holly and Colton reach out about refinance?